Let's dive right into this explainer. Today, we're objectively reviewing the macroeconomic performance and exchange rate dynamics of Costa Rica from May 26th to June 12th, 2026. We are relying strictly on the macroeconomic data to chart the precise behavior of the Costa Rican colón against the US dollar in the foreign exchange market, MONEX. Our analysis is broken down into 6 distinct blocks. We'll start with an executive summary, then move to the macroeconomic context, exchange rate and volume, volatility measurement, chronological market phases, and finally, our economic interpretation and conclusions. Block 1. Executive Summary. Let's start with an initial overview of the exchange rate. We observe a moderate net depreciation over this window. The weighted average exchange rate, or TCPP, went from 452.74 colones per dollar at the beginning of our period up to 456.61 at the close. That's an absolute variation of 3.87 colones, or a modest 0.85%. During the first week, buying pressure pushed the rate to a maximum of 461.06 before a partial correction stabilized it closer to that 456 mark. Over these 2 weeks, the total negotiated volume reached exactly $515.9 million. The largest movements in the exchange rate were backed by significant increases in traded amounts, indicating these variations responded directly to supply and demand flows. The market absorbed the temporary upward pressure on the dollar without triggering a sustained depreciation process for the colón. Moving to Block 2, the macroeconomic and financial context, where we look at the interacting international and domestic forces. Looking internationally, there's financial uncertainty stemming from geopolitical tensions in the Middle East and global inflation risks. Specifically, U.S. secondary bond markets have discounted increased inflation and adjusted yields, while Europe raised its reference rate by 25 basis points. The U.S. dollar has generally strengthened against other currencies as a safe haven asset, and energy markets saw slight fluctuations with a downward trend tied to an impending agreement with Iran. On the domestic side, Costa Rica's economic fundamentals are the basis for capital inflows that allow exchange rate stability at low levels, offsetting some of those international pressures. The continuous generation of foreign currency from exports, tourism, business services, and foreign direct investment really helped correct the initial upward movement. The supply side continues to maintain the upper hand, limiting upward movements in the short term. Block 3. Exchange rate and volume. Here, we'll detail the hard data and transaction concentration. The data reveals a high concentration of market activity. While the daily average volume was $36.9 million, the peak sessions, June 3rd, 8th, 12th, and 4th, accumulated $244.6 million all on their own. That's 47.4% of the total negotiated volume for the entire 2-week period. Less than 30% of the sessions concentrated nearly half of the total volume. This concentration tells us that the liquidity should be viewed as depth-driven by specific institutional blocks, rather than a permanent condition. The exchange rate is highly sensitive to the treasury needs of a small number of large-scale economic agents or specific interventions. Because of this, large transactions by institutional or corporate participants can create temporary volatility. Block 4. Measuring market volatility. Let's analyze the price dispersion. These indicators reflect moderate general volatility. The daily average range between the maximum and minimum traded prices was just 4.41 colones, highlighted by a very low coefficient of variation of only 0.6%. These metrics do not reflect financial disorder, they simply indicate normal market adjustments. The session on June 3rd represented the peak intraday amplitude at exactly 10 colones. The price ranged from a minimum of 451.50 to a maximum of 461.50. This 10 colón difference was more than 2.3 times the daily average range, and it occurred alongside the highest trading volume of $80.4 million. This was an adjustment between supply and demand accompanied by that peak volume. Following this session, trading ranges gradually moderated. Block 5. Chronological market phases. This is the step-by-step evolution of the market. Tracking the price discovery process chronologically. First, from May 26th to June 2nd, continuous buying pressure pushed the TCP up by 8.32 colones. Second, from June 2nd to June 4th, the market entered an accelerated adjustment phase with maximum volume and volatility. Third, between June 5th and June 10th, a partial correction dropped the rate down to 454.75. Finally, on June 11th and 12th, we observed stabilization around the 456 level, showing how buyers and sellers absorb the interaction of supply and demand to reach a new equilibrium. And finally, Block 6, Economic Interpretation and Conclusions. Let's summarize and look at the forward outlook. The data shows no evidence of sustained devaluation. Instead, the short-term exchange rate is expected to stabilize in a range of 450 to 570 colones per dollar. The robust nature of Costa Rica's macroeconomy, characterized by positive growth, contained inflation, and high reserves, ensures an ongoing structural supply of dollars that limits abrupt upward shifts. While internal fundamentals provide an adequate supply of dollars right now, there could be external pressures in the future originating strictly from international factors. The decisions of major central banks, the international performance of the US dollar, and geopolitical impacts on global capital flows will be the primary determinants of future exchange rate dynamics. However, domestic economic conditions continue to provide stability. This analysis was prepared by Julio Espiosa. The key question remains: what conditions would need to align for the Costa Rican colón to resume its appreciation trend, and when could that turning point occur?